Hi, it's Frank from CappThesis. The S&P 500 just logged its best 3-day move of 2024. We'll discuss just why this is so important. We'll also look at what the next bullish pattern for the S&P will look like, and also compare this rally to what we've seen since the low in 2022. So let's start by talking about the consecutive 1% gains to the S&P 500 just logged over the last 2 days. This hasn't happened a lot. It's the first time in 2024, and actually only the third time we've seen it since the beginning of the rally in October of 2023. It's clearly different than the other two for one major reason. It's happening at a much higher price level, where we know the first one began right at the low, was really part of the breadth thrust that got us to this point. The second one, of course, in the middle of the rally, right in February, began as well. And so we know both times the market had a lot more to go. And of course, getting to almost 30% gain in less than 6 months near the top here in March. However, it does share one common characteristic with both of those periods, and that is the fact that it happened right after key Fed meetings 2 prior times, and again this time. So when we see that highlighted here, again from November 1st, November 2nd, actually the first 1% gain was on that Fed decision day, with the next one being one of the biggest rallies we've seen since the beginning of the whole advance as well. Second one occurred right after the January 31st big decline on Fed Day, with the following 2 days being 1% gains. And again, another way of showing that the bid really has been there anytime there's any sort of dip along the way. And we know that lasted up until March. And just this past time, had to wait a few more days, with Wednesday giving us a back and forth movement, which resulted in a marginal loss, almost at a 1% gain last Thursday, and of course last Friday, and this past Monday it happened again. And so typically what we've seen over the last number of months is, Fed talk, Fed action, Fed meetings, especially with the market getting through those relatively okay. We've seen slingshots higher over the next few weeks. And this is one was in particular very important because it came after one of the biggest weeks of earnings season, some big names reporting numbers, and the market being able to withstand that, if nothing else. And we saw the result now with 2 straight 1% gains. And so putting all three of these together, we know that led to a very big 3-day move. As we just mentioned, at just about 3.2% or so. It was the biggest 3-day advance we've seen in 2024 so far. So we took a look at other 3-day moves of at least 3% going back to last year, just about a year ago. And as we can see, not too many, only 3 prior ones. And as we can tell, they occurred at key points here. Now, we can tell this was coming back from the corrective period that started in February to March, so the very early stages of that in April. And we know that we had another number of months until the top here on that July 27th bearish engulfing pattern, where the other two, going back in that November timeframe, basically the first few days of that rally, and then getting forward when we had some good economic reports, and the first number of weeks of that advance was just extremely strong, which then gave way to the more mature, more consistent rally we've seen ever since. And so, getting back to this point now, again, haven't seen it in a while. And it's a big move. And if this rally is going to have even more legs, we can understand that how this could also lead to additional upside movement over the next weeks to months. But we know this is only about 1 year's worth of data, a very small sample size, no matter how you look at it. So let's pull this back a bit more. This goes back to early stages of 2022, clearly looks much different, with so many more occurring. Not a surprise at all. We know that 2022 was one of the biggest bear markets we've seen recently. And so we had a lot of big movement on either side, whether we talk about 1% moves, which we always refer to both up and down, or we want to look at 3-day moves, 5-day moves, however we want to frame it. We know that just having a big advance like this within a very volatile, very stressful trading environment like this does not give anyone too much confidence, right? And so two totally different market environments from when things began to turn during when the market was falling apart. So let's zoom out even further now, going back to the low from 2009 as the great financial crisis was ending, at least from a stock perspective. And what really stands out from my perspective here is there really hasn't been that many 3% moves over a 3-day basis looking at this in its entirety. Of course, we saw a collection of them, a huge amount of clusters in 2022. We can go back to also 2011 period from that August to November. A lot of volatility there. Other than that, though, they've really happened in a vacuum and have come after stressful environments, quick shots, quick hits for the most part, and then started bigger rallies along the way. And the two most recent examples of that came in the fourth quarter of 2018. Right after that, we know that the big move on December 26th really kickstarted momentum in the opposite direction, and that continued in the early stages of 2019, giving way to a very strong year, very uptrending year of 2019. And of course, right after the COVID lows, right? Big moves stayed with us for quite a long time, but that's where we had it. After that low, and you can't really see it here, but if we recall, later that year, so September and October, we had two quick 10% corrections. Both of those months after that went through, when right as the election came and went, that's when another substantial rally extended through the end of 2021. So if we look at the current period, what's it more like right now, looking at things as they currently are? Is it more like 2022 and 2011 when there was excess volatility with us for months on end? Or is it coming in the middle of an uptrend we just saw its biggest pullback of 6% in 6 months, right? So of course that looks like a pullback within a vacuum where we have this reaction to that. And if that is the case, then we can make the case that this could give us additional upside action like we've seen in these other examples going back over the last 10 to 15 years. And so zooming back into more short-term price action, and this is a 2-hour chart which we look at a lot. So 3 necessary traits that we talked about in a piece recently for CappThesis clients. Number 1, you wanted to see this rally extend to at least 4%. Why is that? If we look back to all the different intermittent rallies here, all on the way from the October low to the March high, each one of them was at least 4%. And so that led to, as we know, a rally that was almost 30% that lasted until March. Each one of those as well was able to produce an overbought reading. Looking on, again, the 2-hour chart here, 14-period RSI, where as we talked about it, it was still just getting through this midpoint. So clearly has gotten to overbought after the big 3-day rally we just had. And the third piece we haven't gotten just yet, and that is to overcome or make a higher high compared to what we just had. That may take some time because it was easy as we were going higher because the pullbacks were so minimal. This one, as we know, 6% would have to rally more than the 6% to get to that point. So I would point to what really happened here and compare this initial rally from the October low, and it didn't really get too much above the early October high until after a small amount of pausing and then going back up again. So I think that's what we have to look for, because we wouldn't be surprised to see it all, another pause before we get back to that high again and then form what could potentially be a bigger pattern, which we'll look at in a second here. So looking in at the daily price action, again, it's very helpful along the way because we can see trends develop on a day-to-day basis. And so as we know back here, a lot of red no matter where we look at, we got an indication that things were possibly changing when breadth started to improve. So anything over 50%, of course, is bullish for the S&P, or at least is constructive along the way. And so recently, as we can tell, a lot more volatility on both sides with the big moves on either side. But now we've had 4 1% gains going back over the last 2 weeks compared to 1% decline. Clearly, that's an edge for the bulls. And then seeing the breadth come back well at the same time. And this may be slight, but we're having more stocks make new 52-week highs. We talked about last time how we couldn't get too much above 30 on those failed rallies in August and September. And so we're getting close to that again now. So seeing, this continue to improve is going to be, of course, bullish. And then recently seeing technology and comm services come back as leaders, as we know, helping any market cap related index, S&P 500, NDX, or anything else like that. And so really want to see more of the same as this. What you don't want to see is just the bigger names lagging as they did here. And not a surprise, this is during one of the toughest times for the market. So that takes us to the pattern work, which we like to end with a lot in these videos. And so this is the pattern grid that we use in every morning's piece for CappThesis clients, showing that there currently are two bullish patterns. And one of them, of course, has been with us for quite some time, and one just got triggered on Friday. I got an extension this past week. And so here's the big bullish pattern that's been in place since the middle of January. 6,100 target still 17 to 18% away. So we don't expect that to get acquired anytime soon, if it in fact actually does. More importantly is that we continue to be above the breakout zone near 4,800. And that was the best characteristic of this, the best trait that we've seen, because it had given the S&P the ability to back and fill for an extended period of time if they needed to. And so far, it's taken advantage of that in the most constructive way possible, and not even visiting the 4,800 level thus far. And then here is the short-term cup and handle pattern that was made possible by having a higher low here just a few days ago, rallying from that point, and that slingshot higher over the last 3 days has been able, the S&P has now been able to overtake its 50-day moving average along with many other indices and ETFs, and has broken out from the short-term pattern as well, which would have a target above the previous highs, just about near 5,300. And so potential patterns. Now, this next chart, got a lot of attention when we first talked about it in our piece and also put it on X, and that was showing how there were two different iterations of the same chart, where you have a potential topping pattern, which a lot of people like to see, and then a potential bullish blueprint of a pattern with, of course, much more work to do to actually get this to complete itself. And that was from just last week. This is what it looked like. This is the chart we used in the last video. And so things have changed over the last week with things, of course, coming back. And so this is what the potential bearish pattern looks like as of the close on May 6th here. And so a good amount above the 50-day moving average. So this does not look as symmetrical, if you will. At this point, we can still have a lower high at any point over here. But in terms of having this picture perfect like bearish top play out, that one is now behind us. So we'll see how this develops going forward. And you recall we had different versions of potential top back in the fall as well. And it took really the third iteration of it to actually see a downside break by the time October came. But as we talked about last time, that didn't hit its downside target, and we saw a slingshot higher soon after the break. And so the bullish pattern now getting closer, right? We still don't think it's going to shoot right through the top. Wouldn't be surprised to see a pause at any point between now and say 52.50 or right near the high. But the point of this whole exercise was to say, if this market is going to do the most constructive thing is obviously have the dip bought, but then form a constructive pattern over the next few weeks to even months. So seeing this extend even into June, knowing that May seasonality hasn't been the best over the years, that would be the best case scenario. And so far, it is playing out like that. So we'll see what happens over the next few weeks. And lastly, all of this has been occurring still within this much longer upward sloping trading channel that's been in place since the October 2022 lows. And the reason why we have these colored here is that these are the only periods where the market's pullback initially did not take it all the way back down to the lower line. And so we saw that worked out very well back in early stages in the pullback in December, held, and as 2023 began, saw another rally that took us back up to that upper line before the February to March pullback ensued last year. Where it did not work too well is the initial rally from August into September of last year, as we know, produced a lower high and then really two more down legs had to come through before actually seeing that low last October. So that brings us to right now. We have another attempt at the market trying to rally from a higher low without getting back down to the lower level. And so far, so good from this stage. And again, everything we talked about is we need to play out for this to continue to work, meaning that this consolidation phase already has confirmed one bullish pattern, seeing that target hit eventually, again, above new highs, clearly be constructive. More so, though, seeing how the S&P does near its former high and continue to form an even bigger bullish pattern would be the best possible scenario. That's it for today. Check out these videos and subscribe, and talk to you next time. Thank you.